Welcome to chapter 15. What is the S&P rating? In this chapter, we are going to learn what is a credit rating, and then we are also going to learn what does a rating tell me about risk. So let's get started. All I'm doing is highlighting different credit ratings and how they impact you as an investor. So when we look at this chart, we have three different major credit rating companies, which is Moody's, the S&P, and also the Fitch. And basically, they have the exact same rating scheme. Here you will see, as you go on the screen to Moody's, they have a big A with two lowercase a's, whereas S&P uses a three capital A's. But it's all the same thing. It's all the same scale. And as you look at the scale over on the right hand side, if you focus over there on the right hand side, you can see that at the very top we have a prime investment, meaning it doesn't get any better. This is a company that's absolutely going to be able to repay the debts. And then at the very bottom, as you look down at the bottom, the lowest is in default. Okay. And that's what you really want to stay away from because that's a company that's going under. They are going to go bankrupt, or even a municipal government or a state government that's going to go bankrupt, and so they are not going to be able to repay their loans. So if you are buying a bond, and let's say you bought a triple A bond, and the chance of that company or government repaying all your coupons and then giving you your par value back at the end of the investment is very good with a prime investment. For the one that's rated in default, it's very bad. And then everything in between is something that you would have to figure it out. So as you go down the scale, the two main categories here, as you look at this chart, is that there is an investment grade and there is a non-investment grade. And so everything that's above the triple B minus, or that the B lowercase a 3 for Moody's, everything above that is considered investment grade, and anything below that is non-investment and understood as being speculative. So it's pretty important to understand. So this can work for bonds or this can work for stocks. Say you are considering buying a stock, you are kind of concerned because maybe the company has a little bit more debt. Then what you could do is go into corporate page, I mean the company's page. You could look up the information on the company and you can look at the debts that they have, and they look at their bonds, and then you look at their bonds, you could see what the categories for those bonds that the company has out. So if you are looking at a company and they have a bunch of triple A bonds, that's probably a company that's under no circumstance is going to be in trouble to repay those debts, which is a good thing. And that's what you are looking for, especially when you are buying stocks. You want to buy a stock that has a very minimal debt. And if they do have that, it needs to have a very high credit rating. Now, when you're buying bonds, you can maybe flirt with coming a little bit lower. But that's all based on the amount of risk that you are willing to assume. So the thing that I get frustrated with whenever I look at charts like this is that what does a double A bond mean to you? How much risk is that? And there is no way a person can actually answer that question without knowing numbers that are associated with that rating. And so kind of laugh, when I see these charts because they really don't tell anybody anything because there is no statistics behind it. So I'm going to throw some statistics behind it to kind of show you what some of these ratings equal. Now, unfortunately, I just have Moody's and the S&P numbers here, but it's pretty neat to kind of look at this chart and you can see the comparison. So that number up there is how many of them actually defaulted based off a percent. So as we look at the very top, the triple A rating from Moody's, if you are a municipal government, both Moody's and the S&P, if you add that rating, there was a 0% chance of you actually going in the default. But if you're a corporation, you can see from Moody's it was 0.52%, and for the S&P it was 0.6%. So that's how much risk you can put a number on it, how much risk was associated with that rating for both of these organizations. So let's go down. And if you remember, I said BA or the BB is whenever things starts becoming speculative in non-investment grade. And if you look at those numbers, you can see a drastic change in the numbers. Something I find kind of interesting is let's look at the corporation number for the BB. For Moody's, that went to 19%, nearly 20% of those companies went into default. 20%, that's really high in my opinion. When you look at S&P, they actually had almost 30%. So S&P, you can see, has a much more liberal rating compared to the Moody's. That's much more conservative and consistent. So as we look and when we go even lower on the screen, you can see on how much higher those numbers go. So when you look into the C category, especially for the corporation, 70% for both Moody's and the S&P. That's extremely high. So if you are buying bonds that are down there, there is only about a 30% chance you are going to get your money back, which is really, really low. So it's nice to know numbers behind these letters, which can mean absolutely nothing to anybody for a person who is not intimately involved with buying and selling bonds. So when you look down there at the numbers for the averages, if you're buying investment grade bond for corporations with a Moody's rating, there is only a 2% chance that is going to fail. And for the S&P, it's double that it's 4%, which is very significant when you look at how these ratings are done. Now, for the non-investment grade, the numbers go much higher, especially for the corporations here at the 31-42 percentage range. So, something that is really interesting, people will look at a triple A rating for a corporation, but that's almost the same as being down there in a triple B for a municipal. And that's something that people really don't understand or have any idea about. So if you are comfortable buying a triple A corporate bond, you should be equally comfortable buying a triple B municipal bond because the numbers are actually better than the triple A corporate. So that's something to really think about whenever you are buying bonds, and think about this chart and how secure those municipal bonds are as you go into a lower category and rating. So what's important here is something that I will strongly suggest, and there is a quote from great investors like Warren Buffett and Charlie Munger: a public opinion poll is no substitute for a thought. So just because a lot of people were scared to go and buy the triple B municipal bond doesn't mean you should be. I mean, you can back up your thoughts with calculations and with statistics, and you can put some numbers to what's going on. Don't just buy into what somebody said, or you should buy only triple A bonds. You can look at this and determine things for yourself. Looking at letters at that letters is pointless. You need to understand the statistics behind the letters. So that's something that I encourage you to go out there and seek and do some research on as you become more interested in investing in bonds. In the end, you need to measure your own tolerance for risk and be realistic in what you actually know. And that's some of the best advice I can give you for investing in bonds and also for investing in stocks. So this concludes chapter 15, what is the S&P rating. In this chapter, we learned about what is the credit rating was, and we learned what does the rating tell us about risk. And I will see you in the next lesson.